I want to start today by asking you to hold a number in your head. It's a number so large that it is, frankly, difficult to visualize. The number is 1.3 billion.
It's a massive number.
Yeah.
Just purely in terms of scale, it's hard to comprehend.
It is huge. Specifically, I'm talking about 1.3 billion mobile subscribers. Imagine that.
Right.
That's roughly 1/6 of the entire global population. It's more than the population of Europe and North America combined. And here is the kicker, the thing that really stopped me in my tracks when we were preparing for this deep dive.
Okay.
There is a single company that processes the data of those 1.3 billion people.
Right.
Every single day.
Right. And if you were to guess who that company is, based on that scale alone, your mind immediately goes to the tech titans.
Of course.
You'd say Google or Facebook, maybe Amazon,
Yeah.
or, a massive telecom operator themselves.
Yes.
Like a Vodafone or a China Mobile. You'd expect it to be a household name.
Exactly. You expect a company with a skyscraper in New York or a sprawling futuristic campus in Silicon Valley with, I don't know, free kombucha on tap.
Yeah, the whole 9 yards.
But the company we're talking about today, it isn't a household name. In fact, unless you're deep, and I mean deep in the weeds of the Indian stock market or the back-end software of, say, African telecom operators, you have likely never heard of them.
We are talking about PELATRO.
PELATRO. It almost sounds like a villain in a Bond movie, doesn't it?
Well, yeah.
But it's actually a micro-cap software firm listed on the NSE Emerge in India. And this is the central contradiction that hooked me immediately, the thing we have to unpack.
It's this massive asymmetry.
Yes. You have this massive global footprint operating in over 50 countries, touching 1 billion-plus lives daily, and yet the market valuation is hovering around, 368 to 380 crore rupees?
Which is incredibly small relative to that reach. We're talking about roughly 45 million US dollars.
45 million.
For a software company processing data for a sixth of the world, that valuation is almost a rounding error for the big tech giants we just mentioned. It's nothing.
So that is our mission today. We are going to unpack this invisible giant. We're diving into the world of telecom software, specifically a niche called customer value management, or CVM.
And honestly, customer value management sounds like the most boring corporate jargon imaginable.
It really does.
It sounds like something you'd see on a PowerPoint slide that puts everyone to sleep. But when you peel back the layers, it's actually the engine room of the modern digital economy, especially in the developing world.
So what's our goal here? What are we trying to figure out?
Our mission for this deep dive is to understand how a small player like PELATRO is capitalizing on this massive digital explosion in emerging markets. We're talking Africa, Asia, the Middle East.
Right. And we also need to get into the mechanics of their financial turnaround, because this is a really interesting story of going from losses in fiscal 24 to, well, what looks like massive profit jumps in 25 and 26.
A huge swing. But we can't just talk about the good stuff. We also have to look at the existential risks lurking in the background.
The red flags.
There are some big ones. We need to talk about why a UK corporate strike-off proposal might spoil the party. And then there's the looming shadow of AI that hangs over this entire business model.
Okay, that's a lot to cover. So before we get into the turnaround and the risks, let's start with the basics. De-jargonize this for us. What exactly is customer value management?
It doesn't roll off the tongue, does it?
Not at all.
But you interact with it almost every day, or at least billions of people do. To really understand PELATRO, you have to step outside of the Western postpaid bubble. If you're listening to this in the US or the UK, you probably have a contract with your mobile provider.
Right. I pay my bill once a month, I have unlimited data, and I really don't think about it much.
You don't. You've probably had the same carrier for 5, maybe 10 years. You're what they call a sticky customer. The friction to switch is high.
Yeah, it would be a huge pain.
But PELATRO operates in what the industry calls the next billion users markets. We're talking about the Caribbean, Eastern Europe, North Africa, South Asia, Southeast Asia, and specifically Sub-Saharan Africa. In these markets, the model is overwhelmingly prepaid.
Meaning you pay as you go, you top up your phone with credit.
Exactly. You buy credit in small chunks. And because of that, there's basically zero loyalty. A typical user in, say, Nigeria or Bangladesh might have 2 or 3 SIM cards in their pocket from different providers.
The multi-SIM phenomenon, right? I've seen that.
Precisely. They'll check which carrier has the best deal for data today, pop that SIM in, and use it. Tomorrow, they might swap to a different SIM because calls are cheaper on that network for the next 24 hours.
So the churn, the rate at which customers leave a provider, must be incredibly high.
Through the roof. People just throw away SIM cards. So the telcos in these regions are in a constant state of, well, almost panic. They are fighting for the customer's attention and their wallet every single day, every single hour.
They can't just send a bill once a month and hope you pay it.
No, they have to give you a reason to keep their SIM card in your phone right now. And that is where customer value management comes in. It's the brain behind that fight.
Okay, give me an example.
Think about the last time you got a text message from your mobile carrier. Maybe it said something like, hey, you've used 90% of your data for the month. Click here to top up and get an extra 1 GB for free.
I get those, usually right when I'm in the middle of trying to stream a video and it starts buffering. The timing is always perfect.
Exactly. That timing isn't an accident. That is the management part. That text wasn't sent by a person sitting in a call center.
Right.
It was triggered by a software engine that is analyzing your usage patterns in real time. It knows you're streaming, it knows your data balance is low, and it knows, based on your history, that if they offer you a specific deal at this exact moment of need, you are, say, 80% likely to say yes.
So that brain behind the text message, that is what Pelatro builds.
That is precisely what they build. Their flagship product is called Enviva. They describe it as a customer engagement hub. And the key word that makes it all work is context.
Context, meaning it's not just blasting spam to everyone.
It's the opposite of spam. Spam would be sending everyone a buy more data text at 2 p.m. on a Tuesday. Contextual campaign management, which is Enviva's core function, is about triggers.
So Enviva is watching what I'm doing on the network.
It's watching for data signals. Did you just finish a long phone call? Did you just run out of credit mid-browse? Did you just land in a new country and turn on your phone?
The roaming package offer.
That's a classic one. Enviva takes that data signal, the trigger, and instantly fires off a relevant, personalized offer. Welcome to Kenya. Get 500 millibits of data and 60 minutes of local calls for just $5.
Okay, so that's one part. The contextual campaigns. What else does it do?
Well, another huge piece is loyalty management. It's all about churn reduction. The system can identify users who are at risk of leaving.
How does it know?
It looks for patterns. Maybe a user who used to top up every 3 days hasn't topped up in a week. Or their data usage has suddenly dropped to 0.
So they've probably switched to a competitor SIM.
They probably have. So Enviva can flag that user and trigger a win-back offer. Hey, we miss you. Come back and get 50% off your next 3 top-ups. It's proactive retention.
That makes sense. And you mentioned a third part, data monetization.
This is a really interesting one. It's about helping the telcos make money from the vast amounts of data they have. And we'll get into this more later, but a key example is selling anonymized insights to banks or other financial institutions.
Okay, so we're starting to get a picture of the product. It's this intelligent engine for the telcos. Let's talk about the customers. Who is actually buying this?
So, as we said, they're not selling to you or me. They are a B2B company selling directly to the telcos, the telecommunication service providers.
And the geography is key here.
It's everything. If you look at their client list and their case studies, they aren't fighting for AT&T or Verizon in the United States. That's a brutal, saturated market dominated by giants like Amdocs.
They're not trying to break into Western Europe either.
No, they are laser focused on those emerging economies we mentioned, the next billion users markets.
The source material had a specific stat on this. It was something like they have a presence with telcos in 50-plus countries. And there was a number, approximately 150 telcos in Africa.
That's right. Roughly 150 telcos in Africa and another 30 to 35 in the Middle East. Now, you might ask, why go there? Why not chase the big headline-grabbing contracts in the U.S.?
Well, I assume part of it is because the U.S. market is already locked up by giants. It's hard to compete.
That's a big part of it. But it's also because the problem they solve is much more acute in these markets. The churn isn't as high in post-paid, subscription-based Western markets.
And the nature of the data is different, right?
It is. The volume of data and the velocity of transactions in these prepaid markets are so much higher on a per-user basis. In a prepaid market, a single user might make 5 or 6 tiny transactions a week.
Like top up 50 cents, buy a 1-hour social media pass, transfer 20 cents of credit to a friend.
Exactly. Each one of those is a data point. Each one is an opportunity for engagement. That creates a massive, fast-moving data lake that needs to be managed in real time. It's a volume game.
It is absolutely a volume game. And it sounds like for a long time, playing that game was expensive for Pelatro. It wasn't very profitable.
For a while, no. But recently, something fundamental changed in their financial model.
This brings us to the turnaround story, because if you looked at Pelatro's books in FY24, that's the fiscal year ending in March 2024, it didn't look like a world beater.
No, it was a tough year. The sources mentioned operational stress. They posted a net loss of about 2 crore rupees. Their operating profit margin, which, tells you how much money they make on each dollar of sales before interest and taxes, was a measly 6%.
6%. So they were basically just covering their costs.
Barely. They were just treading water from an operational standpoint, not a picture of a high-growth software company.
And then it's like a switch flipped. The numbers for FY25 and heading into FY26 look like they're from a different company entirely.
They really do. In FY25, revenue jumped to 86 crore rupees. That's up 56% year over year, which is fantastic growth.
56% is great.
But here's the amazing part, the part that gets investors excited. That net loss of 2 crores swung to a net profit of 12 crores.
That's a 14 crore swing on the bottom line.
It's huge.
Yeah.
And those thin 6% margins, they ballooned to around 19 to 21%.
Okay, that is a massive jump. So how does a company go from losing money to making healthy profits that quickly? It's not like they just found a bunch of money on the street. Did they fire half their staff? Did they triple their prices overnight?
It's actually a classic and beautiful economic concept that software investors are always looking for. It's called operating leverage.
Right. Let's really unpack operating leverage. We hear this term thrown around a lot, but how does it actually work in this specific case for Pelatro?
Okay, let's use an analogy. Think about the cost structure of a software business compared to, say, a coffee shop.
Okay.
In a coffee shop, if you want to sell one more cup of coffee, you have to buy more beans, more milk, another paper cup. Your costs go up for every single sale. These are your variable costs.
Right. It's linear. More revenue means more costs.
Exactly. But in a software business like Pelatro, the biggest expense is the build. You have to pay a team of very expensive software engineers to write the code for the Movo platform. Let's say, for the sake of argument, that costs you 20 crore rupees a year in salaries and R&D.
That's your fixed cost.
That's your big fixed cost. And here's the magic. The 20 crore costs the same amount whether you sell the software to one telco or to 50 telcos.
The code is already written. Making a copy of it and installing it for a new customer costs virtually nothing.
Exactly. So back in FY24, Pelatro was bringing in just enough revenue to cover those fixed costs, the salaries, the rent, the servers. They were at the break-even point.
Yeah.
They were just paying for the coffee shop to stay open, so to speak.
They were treading water.
But then, in FY25, they signed up a bunch of new clients. Revenue grew by that 56%. But did their costs grow by 56%?
No, because the software was already built.
The costs barely budged. They didn't need to hire a whole new engineering team for every new client. So that extra revenue, minus some small variable costs like sales commissions, dropped almost straight to the bottom line. It was almost pure profit. That is operating leverage.
So the gap between the revenue line and the cost line suddenly widened, and all of that extra space fell into the profit bucket?
Precisely. We call that nonlinearity, and we see evidence of this in their more recent numbers. In the first 9 months of FY26, their revenue grew 62%, which is amazing. But their EBITDA, their earnings before interest, taxes, depreciation, and amortization, grew by 119%.
Wow. So profits grew almost twice as fast as revenue.
That is the textbook definition of operating leverage in action. And it's the sweet spot for any investor. It means the machine is built, it's paid for, and now you just need to feed it more customers, and most of that new revenue becomes cash.
It's an incredibly scalable model once you get past that initial hump.
That's the key. You have to get over the hump.
So how exactly are they getting paid? What does the revenue model look like? Is it a one-time fee? Here's the software. Good luck.
It's a mix. And importantly, the mix is improving. It's getting better.
Yeah.
Traditionally, you could break it down into 3 buckets.
Okay.
First, you have license fees. This is the classic model of selling the right to use the MViva software. It can be a big, chunky, one-time payment.
Which can make revenue lumpy and unpredictable.
Very lumpy. The second bucket is maintenance and support. This is the good stuff. This is recurring revenue for keeping the system running, providing updates, fixing bugs. It's much more predictable.
And the third?
The third bucket was consulting. This is basically teaching the telcos how to use the data and the platform effectively, setting up campaigns for them, analyzing results.
But consulting sounds labor-intensive. That requires people, which drives up your costs and doesn't scale as well.
It does, and that's the lowest margin part of the business.
Yeah.
But the sources highlight a really important shift in their strategy. They're moving away from this piecemeal approach and toward managed services.
What does that mean in practice?
It means they sign long-term 3 to 5 year contracts where Pelatro essentially runs the entire CVM operation for the telco. It's a full-service package.
Ah, so it's not just selling them the car, it's providing the driver, the fuel, and the mechanic for 5 years.
That's a great analogy. And this is the holy grail for a company like this because it provides something called revenue visibility.
Meaning they aren't just hoping to close a big deal next quarter. They can look at their signed contracts and know, with a high degree of certainty, how much money is coming in the door every month for the next 3 to 5 years.
Exactly. In the volatility of emerging markets, knowing you have a check coming in every month for 5 years is incredibly valuable. It smooths out the bumps in the road. It allows them to plan their own investments in R&D and sales much more effectively.
So to recap this section, we have a working product, Inviva, serving a massive user base. The company has crossed a crucial profitability threshold, and now operating leverage is kicking in, making profits grow faster than sales. And they're shifting their business model to more predictable long-term contracts.
That's the picture.
It sounds like they are perfectly poised to just take over the world. So let's talk about the size of that world. What is the actual size of the prize here?
This is where the story gets into what you might call gold rush territory. We need to talk about the TAM, the total addressable market.
I love a good TAM calculation. It shows the blue sky potential. What are we looking at?
So Pelatro's own management estimates their addressable market at roughly 2,000 plus crore rupees.
2,000 crores.
In US dollars, that's about $240 million. It's a niche, but a very valuable niche.
Okay, 2,000 crores is the potential market, and their current revenue is around 86 crores, you said.
That's right. So if you do the quick math, they're currently capturing less than 5% of their total potential market.
Wow.
In fact, it's probably closer to just 2% of the market they've defined for themselves.
So 95, maybe even 98% of the pie is still on the table waiting to be eaten.
That is the bull case right there, in a nutshell. The runway for growth is absolutely massive. There's a huge long road ahead of them before they even begin to saturate their core market.
How do they get to that 2,000 crore number? What's the logic?
It's actually pretty straightforward. They estimate that there are about 400 to 500 relevant telcos globally that fit their target profile, in emerging markets, high prepaid user base, high churn.
Okay, 400 to 500 potential customers.
And they believe they can extract, on average, about 4 to 5 crore rupees of annual revenue from each of those telcos once they're fully penetrated with all the Viva modules.
4 to 5 crores per telco. That's about $500,000 US. That seems, it seems very reasonable, actually.
It feels very reasonable. For a major telecom company, $500,000 a year for a piece of software that is critical to retaining their customers and driving revenue is not a huge expense.
Especially when you consider the return on investment. If Inviva stops even a tiny percentage of your millions of customers from churning, the software pays for itself in, what, a month?
Easily. The ROI story is very powerful.
But is this market static? Or is the pie itself getting bigger? Is it just Pelatro trying to take share, or is there a rising tide lifting all boats?
But the pie is definitely getting bigger. And this is important because it means they don't just have to steal customers from competitors to grow. There are structural tailwinds here that have nothing to do with Pelatro specifically. It's about the macro environment.
Like what?
Well, first and foremost, digital adoption. In Africa, in Southeast Asia, the smartphone is not a luxury item anymore. For hundreds of millions of people, their phone is their primary and often only computer.
It's their bank, their television, their school, their connection to the global economy.
Everything. So the sheer volume of data traffic flowing through these telco networks is exploding exponentially.
And telcos are sitting on this gold mine of user data.
A gold mine. 10 years ago, they just provided a pipe for voice calls. Now they are the gatekeepers of digital life. They know where you go, what apps you use, how much you spend. But this is a very big, but most telcos are terrible at being software companies.
They're infrastructure companies at heart. They know how to build towers and lay fiber optic cables, not write complex algorithms.
Yeah, exactly. Their core competency is not data science or machine learning. So they are effectively forced to look outside for partners. They are forced to buy software like Inviva because they simply cannot build it in-house fast enough or well enough to keep up with the market.
And then there's the churn pressure we talked about.
It's relentless. As these markets get more competitive, with more players entering, the pressure to retain customers becomes an existential issue. If you don't engage your customer, your competitor will, and they will leave. The telcos don't really have a choice. They have to buy these kinds of tools to survive.
So the demand is real and growing, the market is huge and untapped, and Pelatro is just scratching the surface. It
Yeah.
really does sound like the perfect investment story.
It does sound like it.
But I can hear a but coming in your voice.
There is always a but. If it were a perfect, flawless story, it wouldn't be a microcap company trading at this kind of valuation. The market is pricing in some risk. We need to look at the dark side now. We need to talk about the elephants in the room.
Okay, let's pivot. Let's look at what could go horribly wrong. And I want to start with the biggest, scariest buzzword of the last decade. AI, artificial intelligence.
It is the existential threat for almost every single software company right now, and Pelatro is absolutely no exception.
The argument seems pretty straightforward on the surface. Pelatro's whole pitch is that they do contextual campaigns. They analyze data to send the right message at the right time. Isn't that exactly what modern AI is supposed to be good at?
It is exactly what AI is good at. Pattern recognition, prediction, personalization at scale. That is the bread and butter of generative AI and machine learning. The risk here is disruption from the giants, the hyperscalers.
You mean companies like Salesforce, Google, maybe Microsoft or Amazon?
Salesforce, Google, Twilio, the list goes on. These companies are pouring not millions, but billions of dollars into AI research every single year.
Yeah.
Pelatro is a small company. They have a limited R&D budget.
They can't win an arms race with Google.
No chance. The fear, the bear case, is that a giant like Salesforce comes along and says to a telco, hey, you are already using our CRM to manage your customer relationships. We just launched a new AI agent that does exactly what Inviva does, but it learns faster, its predictions are more accurate, it's cheaper, and oh, by the way, it's already integrated into the Salesforce system you use every day.
And just to sweeten the deal, we'll throw it in for free if you sign a new 5-year contract for our whole suite of products.
Exactly. It becomes a bundling play. The question investors have to ask is, does Pelatro have an AI moat? Do they have something truly proprietary that Google or OpenAI couldn't replicate in a month with a team of 10 engineers?
That is the billion-dollar question.
It is. If their system is just a fancy rules-based engine, meaning if user does X, then send message Y, that is very, very vulnerable to being replaced by an AI that can say, I predict this user is about to do X, so I will proactively do Y, Z, and A to keep them happy.
Yeah.
It's the difference between being reactive and being predictive.
So their only defense is their specialized knowledge.
That's their play. They have to win on specificity. They have to prove that their deep ingrained knowledge of the telecom sector, the specific weirdness of prepaid markets in Nigeria or the regulatory environment in Bangladesh, is something a generic one-size-fits-all AI from Silicon Valley can't figure out. But it is a massive looming risk.
And if a major client does decide to switch to a hyperscaler's AI tool, Pelatro could lose a huge contract literally overnight.
Which is terrifying because of their size. And this leads directly to the second major risk, concentration.
Client concentration risk.
Right. We don't have the exact public breakdown of their client list, but we know they serve leading global telcos.
In the world of enterprise software, especially with these large clients, you often have the whale problem.
Meaning you have 2 or 3 giant clients, whales, that make up a huge chunk of your revenue.
Exactly. If you have, say, 3 clients that make up 50% of your revenue.
And one of them decides to leave or gets acquired or just decides to build their own tool.
Your stock price gets cut in half in a day. The revenue creates a massive hole that could take years to fill with smaller clients. So losing a Vodafone Group or a Robi Axiata would be a catastrophic event for a company of this size. Okay, so we have a major technology risk with AI and a major business risk with client concentration. Those are, fairly standard business risks for a small tech company. But there's something else in the source material that felt a bit more specific, a bit more concerning on the governance side of things. I'm talking about the UK connection.
Yes. This is a red flag that requires some digging. It's not straightforward, but it's important. Pelatro has a corporate structure that spans both India and the United Kingdom. There is a UK entity called Pelatro Limited.
And the sources we looked at mention a strike-off proposal for that UK entity. That sounds bad. What does that actually mean?
A strike-off usually means the company is being involuntarily removed from the official company's register. It can happen for a few reasons, but very often it's because the company hasn't filed its necessary paperwork like annual accounts or confirmation statements on time.
So it's a compliance issue?
It's a serious compliance issue. And the sources note that there are overdue filings for this UK entity stretching back to September 2024.
Overdue filings are never a good look for a publicly associated company. It suggests management is either distracted or disorganized, or maybe there's something happening behind the scenes that they aren't keen to share publicly.
Exactly. And even though the Indian entity, the one that's actually listed on the NSE, Emerge, might be perfectly compliant in filing everything on time, if the parent company or a major sister company in the UK is in legal or regulatory trouble, it creates a cloud of uncertainty over the whole group.
And it creates what we call key person risk.
That's the real heart of the matter here. The key person in this story is Subhash Menon, the chairman and managing director.
He's the founder, right?
Right. Pelatro is very much a founder-heavy, founder-led company. Subhash Menon is the face of the company, the chief strategist, probably the lead salesman. If he is spending 50% of his time on the phone with lawyers in London, fighting legal battles or dealing with complex compliance issues in the UK, who is running the ship in Bangalore?
Who is flying to Kenya to close that next big 5-year managed services deal?
It's a massive distraction at best and a serious liability at worst. And you have to remember, their customers are not small startups. They are massive, conservative, risk-averse bureaucracies. Telcos do serious due diligence on their vendors.
And if their due diligence team Googles Pelatra UK and sees compulsory strike-off proposal,
They might think twice about signing a 5-year contract that makes Pelatro a critical part of their infrastructure. They might just say, you know what, this feels a bit risky. Let's just go with the safer, bigger option. Reputation is everything in this game.
so to pull it all together, on one side of the scale, we have this high-growth, newly profitable turnaround story. On the other side, we have the looming existential threat of AI, the business risk of client concentration, and some definite governance gremlins in the UK. It's a classic microcap dilemma.
It is high risk, potentially high reward. You don't get to buy a company growing this fast at a low valuation without some, hair on the story. The market is pricing in these fears.
So let's assume for a moment that they do navigate these risks. The UK issue gets resolved cleanly. They successfully carve out a niche for themselves against the AI giants. How do they actually grow? What's the path from 86 cores in revenue to, say, 500 cores?
I think you can break it down into 3 main growth vectors or paths forward. The first one is the most obvious, and it's what salespeople call land and expand.
Right. We're already in the door. Now let's sell you the furniture and the curtains.
That's the perfect way to put it. They have already done the hardest part, which is getting integrated with these telcos. They've built the data pipelines. They've proven their value. They have the relationship.
They have the trust.
They have the trust. So now the easiest sale is to go back to that same customer and sell them more modules. Hey, you're loving our contextual campaign manager. Why not add on our loyalty management system to predict churn? Why not buy our new data monetization module to create a new revenue stream?
It's always easier and cheaper to upsell an existing client than to spend money acquiring a brand new one.
Much easier and much more profitable. That's where that operating leverage really kicks into overdrive because the cost of that additional sale is almost zero. That's vector 1.
Okay, deeper penetration. What's vector 2?
Vector 2 is new geographies.
They're already in Asia, Africa, the Caribbean. Where else is there for them to go that fits their model?
Well, there's a huge opportunity in Latin America, Brazil, Mexico, Colombia. These are massive prepaid markets with similar dynamics. There's also deeper penetration into Eastern Europe.
But that sounds harder than the land and expand strategy.
It is much harder.
Right.
This requires boots on the ground. You can't sell a multi-million-dollar software deal to a telco in Brazil over Zoom. You need a local sales team. You need people who speak Portuguese. You need to navigate local regulations and taxes. It's expensive, and it's slow to build out.
But the opportunity is there if they can execute.
It is. But the third vector is the one that I personally find the most fascinating, or potentially the most transformative. It's what you might call ecosystem expansion.
This is about breaking out of just serving the telecom silo.
Exactly. It's about connecting the MViva platform and the data it generates to other industries, specifically banks, in the broader BFSI sector, banking, financial services, and insurance.
And this ties back to that data monetization piece you mentioned earlier.
It does. Think about this. In many of these developing countries, millions upon millions of people are unbanked or underbanked. They don't have a credit history. They don't have a formal bank account. A traditional bank has no way to assess if they're a good credit risk.
But they do have a mobile phone, and they have a history of paying their phone bill.
Bingo. The telco knows more about that person's financial reliability than any bank does. So Pelatro can help the telco monetize that data. The telco can say to a local bank, we have a user here who has topped up their phone on time every single week for the last 5 years. They clearly have a stable, albeit small, income. They are reliable.
The phone usage effectively becomes a proxy for a credit score.
It becomes a credit score. The bank can then use that data to confidently offer that user a microloan, or a small insurance product, or their first real credit card. Pelatro sits in the middle, facilitating that data handshake and taking a cut.
That is huge. That moves them from being just a marketing software company to being a piece of the poor financial infrastructure of a country.
And that is a much, much stickier place to be. If you are powering the credit scoring for a country's emerging middle class, you are incredibly difficult to replace. It cements them into the economic fabric of these nations.
So let's try to synthesize all of this. We have covered a lot of ground. We have the invisible giant processing a billion users. We have the impressive turnaround financials. We have the scary AI threat and the governance issues. Where do we land on this story?
It really comes down to how you view the future and what kind of risks you're comfortable with.
Okay, let's do a final bull case, bear case summary.
The bull case is simple and powerful. You are betting on the digitization of the next billion users. You believe that data usage in Africa and Asia is only going to continue to explode. You believe that telcos desperately need specialized, sophisticated tools to manage that complexity and competition.
And you believe that Pelatro is the best vehicle to ride that wave.
Exactly. You believe that with its low valuation, its proven product, and its massive operating leverage, it is the most direct and potentially lucrative way to play that huge macro trend. If they capture even 5 or 10% of their TAM, this is a multi-bagger stock from here.
Okay, crystal clear. Now, the bear case.
The bear case is that Pelatro is a classic middleman that is about to be automated away by a superior technology. You believe that general-purpose AI will eventually make their specialized software a commodity. You worry that the UK governance issues are a sign of deeper rot at the top.
And you think that at the end of the day, the big telcos will just either build this capability themselves or buy it as a cheap add-on from Salesforce or Google, cutting out the middleman.
That's the bear thesis. It's the classic David versus Goliath story. But this time, Goliath has an army of AI-powered algorithms.
It is. But I think that, so for the listener here, the reason this story matters, even if you never invest a dollar, goes beyond just the stock. This company is a window into a massive trend that we often ignore in the West.
That's a great point.
We get so focused on the latest AI models being developed in San Francisco, but the real revolution, the real impact on human lives is happening in the hands of a teenager in Lagos or a shopkeeper in Mumbai through their mobile phone.
And their digital experience is being curated, managed, and optimized by machines just as much, if not more so, than ours is.
Maybe even more so, because for them, every single megabyte of data counts. Every rupee of credit is precious. The efficiency that companies like Pelatro provide isn't just about clever marketing, it's about making connectivity affordable and accessible.
That's right. Whether Pelatro as a company wins or loses in the long run, that machine, that concept of contextual value management, is the invisible infrastructure of the modern emerging world.
Yeah.
It's not going away.
That's a really powerful way to look at it. It's not just about a clever text message. It's the heartbeat of the new digital economy.
It really is.
Before we wrap up, I want to leave our listeners with one final thought, a question to chew on that builds on what we've discussed.
Look for it.
We talked a lot about AI as a threat, but let me flip it. Here's my question. As AI becomes more accessible to everyone, as it becomes a commodity, an API call away will specialized middleman software companies like Pelatro be the ultimate winners because they're the ones who own the clean, curated, specific industry data that the AIs need to be trained on? Or will they be the first victims of automation by the tech giants?
That is the central paradox, isn't it? AI is starving for good data. Pelatro is sitting on the behavioral data of 1.3 billion people. That's an incredible asset. But AI also replaces process. Can Pelatro successfully pivot from being a process company to being a data company fast enough to survive and thrive?
That is the race they're in right now. And for everyone listening, the next time you get a text from your phone provider that feels just a little too relevant, a little too perfectly timed, remember this conversation. Remember there's a machine like Mviva behind it, processing a billion other people at that exact same time.
An invisible giant, indeed.
Thanks for diving in with us today. This was fascinating. We'll see you on the next deep dive.
My pleasure. Goodbye.